Where do you see markets going into September?
I think we're going to be for a period of more volatility, and I think markets are going to be flat at best, and I think there's actually downside risk. And the downside risk is twofold. Number one, we have this inverted yield curve that we have to deal with, and historically it is the best predictor of business and economic cycles that we have. And then secondly, you look at corporate profits, and we're still getting, a trickle of earnings even today. But generally, the corporate profit picture hasn't been that good. Earnings have basically been flat for most of 2019 compared to 20% earnings growth in 2018 and, in the mid-teens in 2017. So I think for those reasons, I think the markets are going to be choppy, volatile, but I think the risk is to the downside.
It's been interesting in the past two sessions, Mike, is that the sectors that have really been beaten up, sort of left for dead, they came back to life.
Yes.
Retail stocks, financials. I mean, do you see that rotation holding, or in times of volatility, is it still utilities, real estate, staples?
I would say that rotation, that kind of mean reversion by the laggards from the month, it can't be all that works in order for the market to stay supported. But yesterday you did see tech participate. It was pretty broad, I think, in yesterday's session. Today, I think what we know is this morning in the last 2 days, you've been burning up a lot of excessive short-term negative sentiment. You built in a valuation cushion relative to bonds. It's pretty extensive in stocks. If, in fact, the worst of the global slowdown fears don't come to pass. So we've been in this environment with the flatter negative yield curve and all the other factors, and maybe the trade frictions are an exacerbating one, that the lead up to a recession looks a lot like a false alarm for a recession. And the market's been trying to sort that out. So I do think that I think people got way more negative than a 6% decline in the S&P would imply. If you look at the surveys, you look at the flows, you look at how much hedging there's been in August, it seems as if people really got twisted up pretty tightly into the recession story. And that's relaxing. Yields are going higher, and that's enough for now, I think, to keep the market. I think people are more off balance by the market rallying 3 days in a row than they would have been if we went down a little more.
It's just the other market that you look at. I've stopped worrying about stocks because they always seem to come back.
Yeah.
I don't know what the bond market's saying. I guess I'll buy into the global yield story. But if it's not the global, it could be staring us right in the face. It's like, what do you need to show you there's a slowdown coming?
That's right. Yeah, I mean, you definitely don't want to get in the mode of writing it off and saying that this signal no longer works and the
not even
$20 trillion global bond market really has it wrong right now.
Exactly.
Yeah,
not even just the inversion, just the negative yields and the
extreme lows.
There are 5 countries whose entire yield curve is negative.
I know, and it's like 20 trillion now, isn't it? It's like.
How do you ignore that?
Yeah, and it's not necessarily a question of stocks being, right and bonds being wrong or vice versa. If you look at the lead up into recessions, what you typically see happening is, number one, stocks normally rip for the first 6 months after the yield curve inverts. Number two, the data typically improves. Number three, the curve will actually generally even revert. So I think to see, these things playing out right now, it's quite normal. Mike, you mentioned a lead up to a recession. This is exactly what happens when you're coming into recession, because the yield curve never inverts when conditions are bad. It inverts when conditions are good, and we know we can start our countdown timers. And it's an average of about 20 months.
So you think that the 6 month, in terms of the period in which stocks do well, that started, whatever, like 2 weeks ago or whatnot, and now we're just sort of counting down to, that's how you would play it?
Yep, exactly. And so what do you do in a portfolio? I think, number one, the biggest risk out there is in fixed income markets, as you were saying. When you've got all these negative yielding bonds out there, you've got to ask, how's that going to work out? How's it going to play out? I don't think it ends well. So, in my view, it's looking at equities and understanding that, okay, their valuations, they might be a little stretched, but rates are low, but they offer the potential for growth. And when you're buying an Austrian 100-year government bond that's up over 100% from the day it was issued, you got to ask, where's the risk? The risk is a tiny little backup in rates, and you're going to have speculative outflows from all facets of the traditional fixed income markets.
And you're in a spot right now where yields have gone so low below their trend that they can lift a fair bit from 1.5%, let's say, on the 10-year, and still not really disturb much of anything else in terms of the economy, even in terms of stock valuation. And so I think if you look at the really beat up stuff, FedEx at a 3-year low. We know why, right? We know why it looks cheap, but there's still room for it to just bounce. And yesterday, the low volatility stocks, the stuff that has been working, didn't really sell off. So it wasn't like out of one into the other. It was just people found themselves offsides for stocks. The one thing about the 6 month window and all the rest of it, I agree with that, and I think we have to keep that in mind. I just don't think there have been enough cycles to have a lot of precision in saying this is exactly how it goes. When we, once we invert, you get 6 months of great gains and stuff. We just don't know. There's a lot of play, I think, in those dynamics.
Well, if one market is saying one thing and the other is saying something else, and somebody's wrong, I just get nervous that the stock market has a way of readjusting much more quickly than the bond market. Because, I was there in 1987. I remember what can happen.
Oh, in terms of repricing, sure.
Yeah, in terms of repricing.
Absolutely.
Although the day it happened in 87, bonds were up like 300 basis points that day. You've never seen moves like that.
You can just go back to the fourth quarter of last year, less dramatically, but 20% in 3 months without a recession is a notable move. That didn't necessarily have to happen.
Well,
but
stocks can, if you feel real complacent about it, they can shake you up pretty quickly.
Exactly.
Where bonds, it just seems like that seems like a huge global bubble right now, but it takes long.
So the reason I resist the bubble thing is that there's not, yes, a lot of it, they've appreciated a lot in price, a lot of these negative yielding bonds, but I don't think you have a publicly embraced greed story for why bonds should keep giving you great returns. I think it's a kind of a fear or just an acknowledgement that they think central banks are kind of, out of weapons.
Right.
And maybe we ought to appreciate where yields are because we got a lot of debt in terms as a government and in the process. So, here we want it to go up, and it's like, what we end up paying in debt service.
Yeah, we have $22 trillion of sovereign debt at a blended interest rate of like 2%.
Right.
It's amazing.
That's $440 billion of debt service. That's
right. And if it doubles, then